Hi there, this is Mitch from Reverse Mortgage Pros, and in this video, I'm going to walk you through a full explanation of how reverse mortgages work using a real life case study. So you'll learn almost everything there is to know about reverse mortgages in this video, and hopefully I'll answer some of your questions along the way. Now, if you're new to my videos, new to my YouTube channel, I'd love it if you'd hit the subscribe button, hit the like button. That way you'll get more of my content, more of my videos. My goal is to help educate everybody about how reverse mortgages work and help you to understand them better so you can make an informed and educated decision. So hit the subscribe button if you're interested in continuing to learn more about reverse mortgages. So a brief overview of this video. Reverse mortgages can be complicated and confusing, and I know mortgage brokers that don't understand how they work. So whether you're new to reverse mortgage, you've been reading about them for a while, there should be something for you in this presentation. In this video, it'll be around 20 to 30 minutes in total, and I'm going to go through a real life case study covering all the key aspects of a reverse mortgage. I'm going to show you real life examples to help illustrate and explain how they work. So a very brief overview of what a reverse mortgage is, and then I'll give you a bit more background. So reverse mortgage is a mortgage available to homeowners over 55 in Canada that doesn't require you to repay any money. There are no monthly payments. You can get about 10 to 55% of your home's value depending on your age, property type, and location, and I'll walk you through a bit more on that in this example. You can get or take as much money as you qualify for, but any existing mortgage on your home must be paid off first. And again, this example and case study I'm going to walk you through will show you a bit more how that works. And it's designed to help you tap into your home equity for retirement and to help you continue to live in your home for life. That's kind of one of the key features of the product. So a bit more on the reverse mortgage backgrounds before I jump into the case study, and a few kind of common questions and issues that I get with reverse mortgages. So the first is, will the bank take my house? So the answer is no. You own your own home for life, period, no exceptions. I can't explain it any more simply than that. There's zero risk that you will lose your home to the bank. The bank can't actually take your home. This reverse mortgage works exactly the same way as a regular mortgage. So in the same way RBC can't take your home, although actually it's more likely that they might if you missed payments. In this case, there are no payments for you to miss. There's no reason for the bank to take your home, and the home remains in your name, in your ownership, your own title. All the home appreciation gains are all yours. And so the key to think about this is that there's no payments required. So if you had a mortgage of RBC, I'm not picking them out, any of the banks in Canada, and you missed your payments, they might force you to sell your home because you're not making your payments on your mortgage. Reverse mortgage doesn't have any payments, so there's no reason, even less reason, for this lender to make you sell your home. And they're not on title, it's still your home. Title doesn't change. All they do is register a mortgage against the title, just like any other mortgage in Canada. The second thing that's important to know is that credit score and income are much less important, but they're still regulated mortgages, so they'll still be verified and checked. So because you're not making any payments, credit score and income are obviously less important. And in fact, your age, the property type, and property location are more important, and I'll jump into a bit of that when I go through the case study. But these are still regulated mortgages, so the lenders are still going to look at your income and your credit score, and they have to verify that information. They're required to actually, by law, to verify that information. The only time where income might be an issue would be that the lender wants to make sure you're able to pay your property tax and insurance and things like that. So another question I get a lot am I a good fit for a reverse mortgage? Well, the target market are retirees and folks looking to retire who are, I would describe as house rich but cash poor. So if you're struggling to pay the bills, struggling to pay your mortgage, you have a lot of money tied up in your home, you might be a good fit. And I know people who are a very good example for this. That are millionaires on paper, but they're living and barely able to eat food and actually live any kind of reasonable life. But they're paper millionaires because their house is worth over $1 million. So reverse mortgage is a good option for them. They can get some money out of that house so they can actually live like not millionaires, but just live a good, solid, retired life. And then the other key fit at the bottom bullet point here is that you like your home, you want to keep it, and you want to keep living in it. Um, for some people, they might be considering downsizing or moving or right sizing, but they really want to stay in their home, and a reverse mortgage helps them do that. So another kind of question that comes up a lot is, well, if no payments are required, how do lenders make money? And quite rightly, people say this seems too good to be true, which is a good reaction because you don't want to get scammed or ripped off, right? Well, with a normal mortgage, you make a monthly payment, and that is made up partly of a loan payment, paying down the amount that you own, and you're paying interest to the lender. Reverse mortgage, you don't pay down the loan, the amount that you borrow, and the interest is instead added to the amount owed, which then begins to grow over time. And I'll give you numbers and examples in the case study. Then what happens is once the owners pass away, the lender will settle the reverse mortgage with your estate. So that will mean either the estate paying off the reverse mortgage if there's funds there, or the estate having to refinance the home and so maybe your heirs take out a new mortgage to pay off the reverse mortgage, or your heirs pay off the reverse mortgage, or you sell your home to pay off the reverse mortgage. Either way, there's many ways, different ways of doing it. That's when the lender then makes their money, is from your estate once you pass away. So what can you use a reverse mortgage for? Well, the short answer is anything you like. And some common uses are paying off your existing mortgage to free up cash, paying off other debts like car loans, credit cards, personal loans. Home renovations is a big one to make the home more accessible or just improve the home in general. Gifts to your family so you can actually see them enjoy your inheritance while you're still alive. So gifts for down payments are very common use right now with house prices so high in Canada. And then trips, vacations, cruises, other large events that obviously you don't want to spend all your money on that kind of stuff, but they can supplement your retirement and you can do some small trips, vacations, wherever. And then, of course, medical bills, healthcare, anything to improve your living standards. And because it's a loan, it's a mortgage loan, it's still technically you borrowing the money. That makes it tax-free and it doesn't impact any other government benefits. It's not considered income, it's considered a loan, just like a normal mortgage. So now I'm going to walk you through a case study, and everything will make a lot more sense, I think, when you kind of put real names and numbers to it. Now, these are cartoon caricatures of myself, Mitch, and my wife, Emily. I'm not using real customers' names, obviously, for confidentiality reasons. I would never use real customers. So all of the names and the background is kind of made up, but the purpose is to show you common questions and walk you through common scenarios and the process involved for a couple to get a reverse mortgage. So Mitch and Emily are retired and they're both 70 years old and they're considering a reverse mortgage. They own a home in their nation's capital in Ottawa worth $700,000 and it has a $50,000 mortgage. They love living in their home, they don't want to leave it, but they're struggling to pay the bills and live a decent life in retirement. So this makes them a good prospect for a reverse mortgage and it makes it a good option for them. So the first thing that you would do when you're trying to get a reverse mortgage, Mitch and Emily, is figure out how much do they qualify for. So they actually qualify for $250,000 reverse mortgage, about 35% of their home value. That's based on the home value of $700,000. And what impacts this calculation is the property type. So theirs is a freehold house as opposed to a condo or townhouse, which would qualify for less. The location is also good. It's in a major city, and lenders are allowed to lend more money in major cities. They're actually not allowed to lend as much because of actuarial calculations in more urban, more rural areas. And I'll talk a little bit more about this as we go through this example. Their ages will limit the amount a little bit. So the closer to 55 years old you are, the less you're going to get. And the older and closer to 80 and over you are, the more you'll get. So remember I said the range was 10 to 55%. Well, if you're 55 years old, you're going to be closer to that 10%. And if you're 80 years old, you're going to be closer to that 55%. So Emily sees this and she says, $250,000, that's only about 35% of my home's value. What about all those ads I saw that mentioned 55%? Well, in order to get the full 55%, and some lenders let you go even a little bit above this today, you need to be over 80 years old, in a freehold home, and in an area with a track record of regular home sales every day. And this is why being in a major city or a large town is a bonus, and you'll get more money because there's a track record of regular home sales every day. In Ottawa, there's probably 1,000 homes sold every day, and that's important to this particular type of mortgage because at the end of the day, that might be how the lender makes their money if your home is sold in future. And they don't want to lend as much in areas where there aren't a track record of regular home sales happening every single day. And that's the reason why cities and large towns tend to be favored in over more rural areas. The other thing to note here as well is that this is actually conservative lending that's designed to ensure you don't owe more than your home is worth over time. And I'm going to explain a little bit more about this later as well. But the idea is that if you get a reverse mortgage at 55, you might be sitting with that reverse mortgage for 20, 30 years, 40 years. And that's a lot of interest that can add up. And what the lender doesn't want to happen is for you to owe more than your home is worth. So they lend you less when you're 55 years old because they're expecting you to hold that mortgage for longer. So Mitch has another question though. What happens to their existing mortgage of $50,000? Remember that they had an existing mortgage on their home. So existing mortgages and home equity lines of credit must be paid off using the reverse mortgage funds in order to qualify. So in this particular case, the of the 250,000 that they qualify for, the first 50,000 will be used to pay off their existing mortgage, and then they'll have access to the remaining $200,000 in funds. Make sense? That one's pretty straightforward. Now, if your mortgage was bigger than the reverse mortgage available, unfortunately, you don't qualify. Any existing mortgage or home equity line of credit must be paid off first using the funds. And if there aren't enough funds, unfortunately, you can't take out a reverse mortgage until that balance has gone down or you've got a little bit older and qualify for more. So Emily then asks that she isn't sure about it and what are the pros and cons. And this is super common question, and no doubt you've probably thought about this yourself. So I'll start with the pros of a reverse mortgage, and I have a whole video on the pros and cons, so I won't spend too much time on this. But it is tax-free cash to spend however you like, that I've talked about already. You get to keep your home and live in it forever. That's a big pro. No payments are required, so it's great for cash flow. And there's a negative income guarantee, or is also called a non-recourse loan, where you'll never owe more than your house is worth. And I'll talk a little bit about that actually further into the presentation as well. The cons are reverse mortgage. So moving out of your home is actually harder. The irony is people think that the lender's going to come and take their house, but it's the opposite. Now you've put a mortgage on your home, it's actually harder to move out of it because now you need to remove that mortgage when you go through the process of selling your home. It's not super hard. It's usually done by the lawyers, but it's still something to think about when you're selling your home. It's a loan and it's subject to interest, even though you're not paying it and you're not seeing the interest. So remember, it is still a loan. And ultimately, with the interest, you're reducing your estate size for your heirs over time. But again, I'll show you some example calculations that might not be the case. You might actually still be increasing your estate size depending on your particular numbers. So Mitch then says that he heard that the interest rates were really high. So let's talk about interest rates. Well, rates also depend on your age, property type, location, and they obviously vary over time, just like any regular interest rates and mortgage rates. You can lock in your interest rate for up to 5 years at a time, so you can get a 5-year fixed rate, and there are also variable rates available with some lenders and shorter term fixed rates available as well. The rates are generally higher than what you would call an A-level mortgage. So that's if you've got really good income, really good credit score, you're getting an A-level mortgage, and they're generally higher than the home equity line of credit. but then lower than almost all other options to get money other than these two things. So here's a little chart that I made that I'll explain pretty quickly of all different products and ways to borrow money and where the rates fit in. So at the top, you've got higher rate items like credit cards, bank overdrafts, personal loans, second mortgages, B-level mortgages if you don't have good income and credit score, then car loans, and then home equity line of credit and traditional A-level mortgages. Those are the lowest ways you can borrow any money almost at all. So where reverse mortgages fit in is that they are generally pretty close to car loan rates. Right now, they're actually probably a little lower than car loan rates in most places, but usually right about there. And really, the only two ways of borrowing money that exist in Canada that have a lower rate than a reverse mortgage is home equity line of credit and an A-level mortgage. Even the other kinds of mortgages you can get, such as a private mortgage, a B-level mortgage, a second mortgage will have generally have higher rates than a reverse mortgage. So they're out in the terms of mortgages, they're in the middle of the pack, and in terms of borrowing money in general, they're actually still low rate products. So another way to put it is there are only two products in Canada with better interest rates than a reverse mortgage. So Emily says next, this actually sounds good, but I'm scared. Won't the interest eat away at all my home equity? And again, this is a pretty common question and concern. So let's talk about your home equity and keeping your home equity. So remember, your house is still yours, your home is still yours, all the gain and value are still yours. So the majority of Canadians can actually see their home equity go up while holding a reverse mortgage, and particularly in the last 5 to 10 to 20 years where house prices have done very well. This has been the case, and over 99% of homes with a reverse mortgage on them actually have equity left when the reverse mortgage is paid off. So we have a case study here, and so what I would do with Emily is let's take a look at their numbers. So here's the opening situation. When they take out a reverse mortgage, they have about $450,000 equity in their home. So their home is worth home on the left there is worth $700,000. The reverse mortgage on the right there is $250,000. Net those off, you have $450,000 in equity. Now, of course, at this point, they haven't spent any of that money, so they have $450,000 in equity and $200,000 in their bank account. Because remember, the $50,000 mortgage was paid off. So what happens, say, after 10 years? Well, if we use a reverse mortgage rate of 6% and a home value growth rate of 4%, which is reasonably conservative depending where you are in Canada, their home equity actually grows over 10 years to just under 600,000. So what's happened is, remember their house was worth 700,000. It's gone up to just over $1 million over 10 years, growing at 4% a year. The reverse mortgage, remember, was $250,000. It's grown to $447,000 at a rate of 6% over those 10 years. You net those two off, and their previous home equity of $450,000 has actually gone up to $588,459. Put another way, the growth in value of their home has outpaced the interest on the reverse mortgage. And that's how you can still make money and increase your home equity and increase your inheritance and what you're leaving for your heirs while holding a reverse mortgage. And depending where you are in Canada, this is actually a pretty relatively conservative home value growth rate of 4%. If we look back in the last 5 to 10 years, in most areas, it's been higher than that. And certainly in the two big cities in Canada, it's probably double digits, never mind 4%. But of course, sometimes home value doesn't grow the same way it did in the past. So 4% is a pretty reasonable estimate. Some investments analysts use 5%, but I like to use 4. But then Mitch raises a very good point. Well, that makes me feel more at ease. But what if there's a total housing market crash? There's an explosion in the housing market, and unfortunately, it happens right before you passed away. So your house decreased in value, didn't have time to regain in value, which is often what happens after a housing market crash anyway. So in this situation, there are some safeguards. And remember, I mentioned that you can never owe more than your home is worth. It's actually a non-recourse loan. So if there was a complete and utter housing market crash, and let's say Mitch and Emily's home dropped to being worth $300,000, a 60% drop, that's a once in a lifetime, once in a generation, once in 50-year crash. Well, let's say at the same time the reverse mortgage has grown in value and its balance was now $350,000. Well, if the reverse mortgage was $350,000, it would be settled for $300,000 because they can't owe more than their home is worth. So let's say they passed away and then it came time to settle the mortgage and the estate had to sell the home, settle the mortgage. They got $300,000 for the home. The home's only worth $350,000. The lender would have to take a hit on the remaining $50,000 owed, and they don't get that money. So it's a non-recourse loan. There's no recourse for them to collect that money. And this is why lenders are generally very conservative in how much they lend, because they actually don't want to take a hit on their reverse mortgages. They want you to have equity left in their home, because if you have equity left, that means they're going to get paid in full. And if you go underwater and you owe more than the home's worth, the lender doesn't make any money. And then they're actually losing money every single day in that situation. So that's why lenders don't want you to owe more than your home is worth ever. And that's why they'll lend up to 55%, and then how much they lend is based on property type, property location, and age. They're factoring all that in to try and come up with an amount that they can lend that they're comfortable that you'll never end up owing more than the home is worth. And these lenders imply actuaries and very smart people to come up with these amounts. So this is why when I say that 99% of people have never had negative equity and owe more than a home is worth, it's because lenders are smart and they know what they're doing. And even housing market crashes, they factored into their forecasts and their predictions when they're making these lending decisions. So then Mitch asked a good question. So there's not, what other than interest, are there any other major hidden costs? And this is a very good question to ask when you're doing anything, especially when it comes to mortgages, because lenders love to hide costs. So with reverse mortgage, there are some setup fees and costs involved, and most of these are the case with any mortgage. There's probably the third bullet point there, the legal and admin costs. They're a little bit more expensive than a regular mortgage. So you'll have to take out an appraisal. If you're refinancing or taking out a new mortgage with any bank in Canada, any lender, anywhere, you need an appraisal. You'll need to take out independent legal advice, and this can range from about $450 to $700. This is to make sure that you're reading the contract, you're not signing something that you don't want to be, and you're getting proper professional advice. And then the other legal and admin costs. So these do exist with other mortgages because there's costs to register a mortgage on title and legal costs, things like that. And then some of the lenders also charge administrative fees. So that's why there's a range here depending on the lender and the fee setup. Now, almost all of these can be deducted from the reverse mortgage funds, so you don't actually pay them. The appraisal is the only upfront cost, and that will depend on the situation. Sometimes you might need to pay the appraisal upfront and get it back. Sometimes you might need to pay the appraisal and just eat the cost. It really depends. That can change with lenders and products and offers and promotions. But the legal advice and the legal administrative costs are usually deducted from the reverse mortgage funds. So you're looking at $250 to $750 kind of maximum as your upfront actually out of pocket cost here. So Emily's starting to see the light, and she's interested in this, and it sounds good. So she wants to start the application process. So she asks, how does it work? Well, here's how I would walk through the process again in reverse mortgage. So start by getting a free assessment. So this is where I'll take a look at your situation, and I'll see if a reverse mortgage is right for you and in your particular situation. And then I'll send you a qualification amount with the lender that best matches your situation, that will give you what you're looking for, depending on how much money you're looking for, what the purpose is, where you're located, and all that kind of stuff to match you to the best lender. At that point, you'll then have a discussion with them to think about getting an appraisal done for your home, as I mentioned in the previous slides. The appraisal is one of the only upfront costs you have to pay. While that's being done, you'll collect and submit paperwork to the lender. So remember how I said credit score and income aren't important, but they still have to collect and verify that information that's legally required. And they'll also have to do verification of who you are, identity verification, and verify who you are and make sure everything's in order there. Then you'll get your independent legal advice. Remember in the previous slide, I showed you that that's one of the costs to expect, and that's usually done once you've kind of submitted all the paperwork back to the lender. And then the last piece of the puzzle is that you then receive your money, and of course, it'll be net of any existing mortgage. So in case of Mitch and Emily, they would receive their $200,000 with their $50,000 mortgage being paid off. And the $200,000, remember, then also you'll need to deduct the costs and fees that I showed you on the previous slide. So Mitch says, this is great. What if we have further questions along the roads? And again, this is another good question. So my advice is to get professional help and talk to experts who understand reverse mortgages. So my website and YouTube channel that you're watching right now, it's called Reverse Mortgage Pros, and I have dozens of articles and videos to walk you through and help you understand this and make the decision if this is right for you. And ultimately, you might decide it's not right for you. That's totally fine. The key thing is to make that decision based on good information and getting professional advice and help. You can get a free reverse mortgage assessment using the link below the video, and I'll show you the link as well in a second if you're not on the YouTube channel directly. So to summarize this presentation, so it can help to just run through a case study and a scenario of reverse mortgage in real life to get a feel for what the process looks like and what's involved. So this video was a pretty extensive overview of reverse mortgages, how they work and what is involved in getting a reverse mortgage, and hopefully answered some of the questions you may have. Almost all the topics in this video, I have articles on my site and I'll be doing videos on them as well to go into more detail to make sure that you totally understand what's going on here and answer any other points and questions that maybe I didn't cover in this presentation. So if you are interested in reverse mortgage, you can get a free professional reverse mortgage assessment in 90 seconds. I'll advise you if it's a good solution for you. If something better works, all it takes is 90 seconds. It's a free, secure online form, and you can click the link below the video if you're on YouTube, or go to reversemortgagepros.ca/assessment. So reversemortgagepros.ca/assessment. Otherwise, I hope you enjoyed this video. If there's anything I didn't answer, any questions or comments, leave them in the comment section below if you're on YouTube, or you can email me. It's mitch@reversemortgagepros.ca. You can find my contact information on the website if you're either on my website or my YouTube channel. I'm happy to answer any questions. I've got dozens of articles where I've answered hundreds and thousands of homeowners' questions about reverse mortgages, and I love doing it and love helping people out. Thanks, and then enjoy the rest of your day.